My dear students, welcome back to our channel. In this video, I will be explaining the Bcom third semester subject Advanced Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is: explain any four differences between shares and debentures. Differences between shares and debentures. 1. Ownership versus loan. Shares represent part ownership in a company. Shareholders are owners. Debentures are a loan to the company. Debenture holders are creditors. Example: if you buy 10 shares of Infosys, you own a small part. If you buy debentures, you lend money to Infosys. 2. Return. Shareholders earn dividends, which depend on profit. Debenture holders earn fixed interest, paid regularly whether the company profits or not. 3. Voting rights. Shareholders can vote in company meetings. Debenture holders cannot vote. 4. Risk and security. Shares are risky, dividends may vary. Shareholders get residual claim in liquidation. Debentures are safer, often secured by assets. They get paid before shareholders if the company closes. Tip to remember: share is equal to owner, dividend varies, debenture is equal to lender, interest fixed. Next important short question is: 2. What is underwriting of shares? Underwriting of shares. Meaning: underwriting of shares is an agreement by a person or company, called the underwriter, to buy all or part of the shares that are not subscribed by the public during a share issue. It ensures the company raises the required capital even if public subscription is low. Example: suppose ABC Ltd issues 1 lakh shares, but only 80,000 are applied by the public. If there's an underwriter who agreed to take the remaining 20,000 shares, he will buy them. This guarantees that ABC Ltd gets full share capital. Key points. 1. Protects the company from loss due to undersubscription. 2. Underwriters may get commission for this service. 3. Can be fully underwritten. Underwriter takes all unsubscribed shares, or partly underwritten. Tip to remember: underwriter is equal to backup buyer to ensure company gets full money. Next important short question is: 3. Define a prospectus. Prospectus. Meaning: a prospectus is an official document issued by a company inviting the public to buy its shares or debentures. It gives all important information about the company, its financial health, share details and risks, so investors can make an informed decision. Example: suppose XYZ Ltd wants to raise 10 lakh rupees by issuing shares. It prepares a prospectus explaining number of shares and their price, company's business and profits, risks involved, names of directors. Now the public can decide whether to invest in XYZ Ltd. Key points. 1. Mandatory for companies offering shares to the public. 2. Acts as legal evidence. Company is responsible for truthfulness. 3. Helps build trust with investors. Tip to remember: prospectus is equal to company's invitation plus full info for investors. Next important short question is: 4. What do you mean by minimum subscription? Minimum subscription. Meaning: minimum subscription is the minimum amount of money a company must receive from the public when issuing shares, in order to proceed with the share allotment. If this amount is not received, the company cannot allot shares and must return the application money to investors. It protects the company from raising insufficient capital. Example. Suppose ABC Ltd wants to raise 10 lakh rupees by issuing 1 lakh shares of 10 rupees each. It decides the minimum subscription is 7 lakh rupees. If the public applies for only 6 lakh rupees worth of shares, the company cannot allot shares and refunds the money. Only if at least 7 lakh rupees is received can the allotment happen. Key points. 1. Protects the company from undersubscription risk. 2. Usually 25% of the issue or as stated in the prospectus. Tip to remember, minimum subscription is equal to minimum money needed to start share allotment safely. Next important short question is 5. Rahul was holding 100 shares of 100 rupees each, 80 rupees per share called up. He paid 30 rupees on application, but failed to pay 20 rupees on allotment and 30 rupees on first call. His shares were forfeited. Journalize the above transactions for shares forfeited. Given. Shares, 100 times 100 rupees is equal to 10,000 rupees. Called up. 80 rupee per share 100 times 80 rupees is equal to 8,000 rupees. Paid 30 rupees on application. Not paid 20 rupees on allotment plus 30 rupees on first call shares forfeited. Step 1. Receipt of application money. When Rahul pays 30 rupees on application. Journal entry. Bank ACDR 3000. To share application AC 3000. 30 rupees times 100 shares is equal to 3000 rupees. Step 2. Transfer application money to share capital. Application money is adjusted towards the share capital. Journal entry. Share application ACDR 3000. To share capital AC 3000. Step 3. Allotment money due. Allotment 20 rupees times 100 is equal to 2000 rupees, not paid, calls in arrears. Journal entry. Share allotment ACDR 2000. To share capital AC 2000. Step 4. First call money due. First call 30 rupees times 100 is equal to 3000 rupees, not paid, calls in arrears. Journal entry. Share first call ACDR 3000. To share capital AC 3000. Step 5. Forfeiture of shares. The company forfeits shares for non-payment of allotment plus first call. Amount already received 3000 rupees. Journal entry. Share capital ACDR 5000. To share forfeiture AC 3000. To calls in arrears AC 2000. 5,000 rupees called up minus 3,000 rupees received is equal to 2,000 rupee calls in arrears. 3,000 rupee goes to forfeiture AC. Step 6. Key points to remember. Application money received is always transferred to share capital. Calls not paid arrears. Forfeited shares credited to share forfeiture AC. Can be used if shares are reissued. Tip to remember. Paid money stays, unpaid money lost forfeited. Next unit 3. Long questions. First important long question is: define company and explain about the different kinds of shares. Company definition. A company is a legal entity formed by a group of people who pool money to carry on a business. It has a separate legal identity, which means it can own property, sue or be sued, and enter contracts in its own name, separate from its owners, shareholders. Example. Infosys Ltd is a company. Even if the shareholders change, the company continues to exist. Key features. 1. Separate legal entity. Company exists independently of its owners. 2. Limited liability. shareholders are liable only to the extent of their investment. 3. Perpetual existence. Company does not end with the death or exit of members. 4. Common seal represents the company's signature. 5. Share capital. Money contributed by shareholders forms the company's capital. Different kinds of shares. Shares represent ownership in a company. Companies issue shares to raise capital. There are mainly two types. 1. Equity shares, ordinary shares. Represent ownership in the company. Shareholders get dividends, which depend on company profit. Voting rights are provided. Risk is higher. In case of liquidation, they are paid after creditors. Example, you buy 100 equity shares of Tata Motors, you own part of the company and can vote in AGM. 2. Preference shares. Shareholders have priority over equity shareholders in receiving dividends and repayment during liquidation. Usually get a fixed dividend irrespective of profit. May or may not have voting rights. Example, a company issues preference shares at 100 rupees each with 8% dividend. Shareholders will get 8 rupee per year before equity shareholders get anything. Other classifications for exam edge. 1. Redeemable shares can be bought back by the company after a certain period. 2. Non-redeemable shares cannot be bought back, permanent capital. 3. Issued, subscribed, paid up shares, different stages of share issue and payment. Tip to remember. Equity is equal to risk plus reward plus voting. Preference is equal to safety plus fixed dividend. Think of share is equal to ownership slice of the company. Next important long question is: to explain difference between share capital and debentures. Difference between share capital and debentures. Companies raise funds through share capital or debentures, but they are very different in nature. 1. Share capital. Meaning, share capital is the money a company raises by issuing shares, representing ownership in the company. Ownership, shareholders are owners of the company. Return, shareholders get dividends, which depend on the company's profit. Voting rights, shareholders usually have voting rights in the company. Risk, shareholders bear the risk of business losses. Repayment, in case of liquidation, shareholders are paid after creditors and debenture holders. Example, you buy 100 equity shares of Infosys at 100 rupees each. You become a part owner and can vote in AGM. Dividends are paid based on profits. 2. Debentures. Meaning, debentures are long-term loans raised by the company from the public or banks. Debenture holders are creditors, not owners. Ownership, debenture holders are lenders, not owners. Return, they get fixed interest whether the company earns profit or not. Voting rights, no voting rights in company decisions. Risk, lower risk compared to shareholders. Interest must be paid before dividends. Repayment, repayment of capital happens before shareholders in case of liquidation. Example, ABC Ltd issues 1000 debentures of 100 rupees each at 8% interest. The company pays 8 rupee per debenture yearly, even if it makes a loss. Key differences, easy to remember table. Feature share capital debentures. Nature ownership loan credit. Return dividend, profit dependent, fixed interest. Voting rights yes no. Risk high low. Repayment after creditors before shareholders. Example, buying equity shares, buying 8% debenture. Tip to remember. Think of shareholders is equal to owners, profit-based reward. High risk and debenture holders is equal to lenders, fixed reward, low risk. Next important long question is 3. What are bonus shares? What are the guidelines issued by SEBI for issue of bonus shares? Bonus shares meaning bonus shares are additional shares given free of cost to existing shareholders by a company. They are issued from the company's reserves or profits, not by collecting money from the public. Purpose: 1. Reward shareholders without paying cash. 2. Capitalize profits or reserves into share capital. 3. Increase marketability of shares. Example: ABC Ltd has 1 lakh equity shares of 10 rupees each. The company declares 1 to bonus shares, meaning 1 bonus share for every 2 shares held. A shareholder holding 100 shares will get 50 extra shares free. SEBI guidelines for issue of bonus shares. SEBI, Securities and Exchange Board of India, has set rules to regulate bonus shares. 1. Profit and reserves. Bonus shares must be issued from free reserves, securities premium account, or capital redemption reserve. 2. Capitalization limit. The company must ensure sufficient profits reserves are available to issue bonus shares. 3. Equity share ratio. Bonus shares are issued in proportion to existing shareholding. 4. Approval required. Board of Directors must approve and the shareholders must approve in the general meeting. 5. Timing. Bonus shares cannot be issued within 3 months before the record date for dividend and not more than 15 days after the record date. 6. Listing. Bonus shares must be listed on the stock exchange where the company's existing shares are listed. 7. No preferential issue. Bonus shares cannot be issued to select shareholders. All eligible shareholders must get them. Key points to remember. Bonus shares is equal to free reward from company's profit. Issued proportionally to existing shareholders. SEBI ensures transparency, fairness, and proper capitalization. Tip to remember. Bonus shares is equal to company's way of saying thanks without spending money. Next important problem is 4. Shiva Ltd issued 2000 equity shares of 100 rupees each payable as follows. 20 rupees on application, 30 rupees on allotment, 20 rupees on first call, 30 rupees on final call. 1500 shares were applied for and allotted. All money were received with the exception of first and final call on 50 shares. These shares were forfeited and reissued at a later date at the rate of 70 rupees per share. Give the journal entries to record above transactions in the books of company. Given. Total shares issued is equal to 2000 at 100 rupees each. Payment schedule. On application is equal to 20 rupees. On allotment is equal to 30 rupees. On first call is equal to 20 rupees. On final call is equal to 30 rupees. Shares applied and allotted is equal to 1500. 50 shares defaulted on first and final call forfeited. Reissued forfeited shares at 70 rupees per share. Step 1. Journal entry for share application money received. Calculation. Application received is equal to 1500 shares times 20 rupees is equal to 30,000 rupees. Journal entry. Bank ACDR 30,000. To share application AC 30,000. Step 2. Transfer application money to share capital. Allotment applied is equal to 20 rupees per share for 1500 shares is equal to 30,000 rupees. 20 rupees per share from application goes to share capital. Share application ACDR 30,000. To share capital AC 30,000. Step 3. Journal entry for allotment money received. Allotment money due is equal to 1,500 times 30 rupees is equal to 45,000 rupees. Bank received full except for 50 shares. 50 times 30 rupees is equal to 1,500 rupees defaulted. Bank received is equal to 45,000. 1,500 is equal to 43,500 rupees. Journal entry. Bank ACDR 43,500. Calls in arrears ACDR 1,500. To share allotment AC 45,000. Step 4. Journal entry for first call money received. First call due is equal to 1,500 times 20 rupees is equal to 30,000 rupees. 50 shares times 20 rupees is equal to 1,000 rupees defaulted. Bank received is equal to 29,000. Journal entry. Bank ACDR 29,000. Calls in arrears ACDR 1,000. To share first call AC 30,000. Step 5. Journal entry for final call money received. Final call due is equal to 1,500 times 30 rupees is equal to 45,000 rupees. 50 shares times 30 rupees is equal to 1,500 rupees defaulted. Bank received is equal to 43,500. Journal entry. Bank ACDR 43,500. Calls in arrears ACDR 1,500. To share final call AC 45,000. Step 6. Forfeiture of shares. Forfeited 50 shares. Amount received per share is equal to 20 rupees. Application plus 30 rupees. Allotment is equal to 50 rupees. Share capital AC 50 times 80 called up DR 4,000. To share forfeiture AC 2,500. To calls in arrears AC 1,500. Share capital reduced by total called up is equal to 80 rupees times 50 is equal to 4,000. Received money is equal to 50 rupees. Calls in arrears is equal to 30 rupees split accordingly. Step 7. Reissue of forfeited shares. Reissued 50 shares at 70 rupees. Bank is equal to 50 times 70 equals 3,500. Original capital is equal to 50 times 80 equals 4,000. Loss is equal to 500. Transferred from forfeiture AC. Journal entry. Bank ACDR 3,500. Share forfeiture ACDR 500. To share capital AC 4,000. Tip to remember. 1. Always calculate money received versus money due. 2. Forfeited shares remove from share capital. Record received money in share forfeiture AC. 3. Reissue use bank plus forfeiture AC to balance share capital. Next important problem is 5. ABC Ltd issues 2,008%. Debentures of 100 each. Give journal entries and balance sheet in each of the following cases. A. When debentures are issued and redeemable at par. B. Debentures issued at discount of 5% but redeemable at par. C. Debentures are issued at a premium of 6% but redeemable at par. D. Debentures issued at par but redeemable at a premium of 5%. E. Debentures issued at a discount of 5% but are redeemable at premium of 5%. Given. ABC Ltd issues 2,000 debentures of 100 rupees each. Rate is equal to 8%. We need journal entries and balance sheet treatment for different cases. Case A. Debentures issued and redeemable at par. Step 1. Issue of debentures. Issue price is equal to face value is equal to 100 rupees. Total received is equal to 2000 times 100 is equal to 2 lakhs rupees. Journal entry. Bank ACDR 2 lakhs. To 8% debenture AC 2 lakhs. Balance sheet treatment. Liabilities. 8% debentures AC 2 lakhs. Case B. Debentures issued at 5% discount but redeemable at par. Issue price is equal to 105 is equal to 95 rupees. Total received is equal to 2000 times 95 is equal to 1,90,000 rupees. Journal entry. Bank ACDR 1,90,000. Discount on issue of debenture ACDR 10,000. To 8% debenture AC 2 lakhs. Balance sheet treatment. Liabilities. 8% debenture AC 2 lakhs. Less discount on issue 10,000. Net 8% debenture liability 1,90,000. Case C. Debentures issued at 6% premium but redeemable at par. Issue price is equal to 100 plus 6 is equal to 106 rupees. Total received is equal to 2000 times 106 is equal to 2,12,000 rupees. Journal entry. Bank ACDR 2,12,000. To 8% debenture AC 2 lakhs. To securities premium AC 12,000. Balance sheet treatment. Liabilities. 8% debenture AC 2 lakhs. Securities premium AC 12,000. Case D. Debentures issued at par but redeemable at a premium of 5%. Issue price is equal to 100. Total received is equal to 2 lakhs. Redemption value is equal to 100 plus 5 is equal to 105 rupees per debenture. 2000 times 105 is equal to 2,10,000 rupees. Journal entry. Issue. Bank ACDR 2 lakhs. To 8% debenture AC 2 lakhs. Balance sheet treatment. Liabilities. 8% debenture AC 2 lakhs. Add premium on redemption liab 10,000. Total liability 2,10,000. Case E. Debentures issued at 5% discount but redeemable at 5% premium. Issue price is equal to 105 is equal to 95. Bank received is equal to 2000 times 95 is equal to 1,90,000 rupees. Redemption value is equal to 100 plus 5 equals 105. Liability is equal to 2000 times 105 is equal to 2,10,000 rupees. Journal entry. Issue. Bank ACDR 1,90,000. Discount on issue of debenture ACDR 10,000. To 8% debenture AC 2 lakhs. Balance sheet treatment. Liabilities. 8% debenture AC 2 lakhs. Add premium on redemption liab 10,000. Less discount on issue 10,000. Net liability 2 lakhs. Tips to remember. 1. Issue at par bank is equal to debenture AC. 2. Issue at discount debit discount on issue. 3. Issue at premium credit securities premium AC. 4. Redeemable at premium add premium on redemption liab. Mnemonic. Discount drags down, premium perks up, redemption premium adds more.